Well, good morning, everyone, and thank you for attending today. Today's October 22nd, 2025. My name is Tiffany Scruggs, and I'll be helping facilitate today's training. I'm delighted to have Cara Skinner here today. She is known as the Bonder. And before I officially introduce Cara, I would like to see if Emily Ho is here and can unmute and just say a quick welcome from the Port of Seattle. Emily, are you here?
Hi, good morning. Good morning, Tiffany. Good morning, everybody on the line. Thank you for joining us. I just want to say, thank you so much for taking the time to be here to learn and grow your business. Thank you very much to Tiffany and Apex for helping the port put this amazing program on. I think this is the third to last. There's two more sessions, but they've been amazing. And I think Kara's will definitely not be an exception at all. I've sat in on the classes that Kara taught and have been like, wow, she actually makes bonding and things like this accessible and interesting and fun. So I'm really excited for this session.
Great.
Thanks, Tiffany. Thanks, everyone.
Thanks, Emily. Yeah, this session is part of a series of trainings called Advanced PortGen, and it's designed to enhance businesses' ability to do business with the port and other local agencies. So today we have expert speaker Cara Skinner coming to join us today. She's known as the Bonder, and she's with Integrity Surety. Cara is a third generation surety bonder, which, if you could imagine her dinner table chat with her family, is all about bonding. Like I think Cara lives this, breathes this, and eats this on a daily basis. And like Emily said, she makes it accessible for small businesses. We will have time at the end for questions. So please hold on to those or type it in the chat. And then we'll get to them at the end. And then next week, as I think we'll reference today during the slide deck, is that we have our advanced surety bonding class, which is something that we haven't seen in this region in a long time. So if you got the basics down after today and you want a little bit more advanced, looking forward to that event. So Cara, please take it away.
Thank you so much. Appreciate the introductions. Good morning, everybody. For those of you that have been through this before, I would try to mix it up a little bit and do a little bit of different things. Uh, as Tiffany said, Cara Skinner, Integrity Surety. I'm in Seattle, but we write bonds nationwide, third generation surety bonder. So yes, I do live and breathe bonds. I really think it's fun and interesting, and I know that sounds really dorky. But when I first got into the business, even though I grew up in it, I still didn't know a whole lot. So I wrote when I was just starting in the business, I had a little notebook that I hid in my desk of things that I would learn as I was going along. I would write things like RCWs and some underwriting stuff, that kind of thing. I eventually found it many years later and decided that it would be a good reference for other people coming into the industry. So that's when I wrote the Little Black Bond Book. And if you go to littleblackbondbook.com, you can download a free copy. Or if you want a copy like this, you can order a copy like that as well. It's an introduction. It was an interview that I did with someone who didn't know what bonds were and just answered all their questions. There's a little glossary in the back and some space for notes as well. So it's meant to be a handbook and not a novel. All right, bonding basics. So, what is bonding? I like to start with what it's not because sometimes it's easier in our brains to start with what something isn't before we go into what it is. And it is not insurance. And if you've ever taken my class before, you've heard this a million times. It is the opposite of insurance. Bonding is assurance. So we are guaranteeing something's going to happen, or that somebody's going to do something, or that they're not going to do something. It is a credit relationship. And the more you learn about surety, the more it's going to feel, and you're going to understand more about why it is a credit relationship. Bonds are a privilege, not a right. Not everybody gets a bond. It's not like insurance where you can pay more to get insurance. You can't pay more to get a bond. Either you qualify for the bond that you're looking for or you don't. And then we help you qualify for the type and size of bond that you're looking for. Since you as a contractor, I'm going to assume everybody here is a contractor, since you're probably going to go to an insurance agent to get your bond, I think it's nice to see the difference side by side, the difference between surety and insurance. I'm going to say usually or sometimes when I'm referring to almost anything, because nothing in surety, nothing in business, nothing in life is absolute. So usually surety is a three-party agreement, whereas in insurance, usually it's a two-party agreement. So most people here have probably purchased insurance. So you know you're one of the parties and the insurance company is the other party on the insurance contract. For surety, the bond does not protect you, the one applying for it. It protects a third party. Whereas in insurance, when you buy an insurance policy, it's protecting you. So that is a part of the opposite part, right? The bonds that we're going to talk about today are project specific, right? Whereas in insurance, when you buy an insurance policy, usually it's for a term, right? Homeowners or car insurance, you're going to buy it for 1 year. You might pay monthly, but it's for a specific term. Claims for surety are not filed by you, the contractor. They're filed again by a third party, the obligee. The insurance, when you have an insurance policy, you get to file a claim, right? Insurance also anticipates losses. So the idea of insurance is we pool our money with an insurance company, and if somebody in that pool has a loss, then that loss is paid. Whereas for surety, because it's a credit relationship, no losses are anticipated. Now, that doesn't mean losses don't happen, but when we underwrite, we want to underwrite and give bonds and approve bonds for contractors we know can do the work. So we're not anticipating losses. We're not pooling funds to anticipate a loss. So those are some of the main differences between surety and insurance. Something I don't have on here, but here's the thing that is the same. Both the surety bond and an insurance contract help mitigate loss and risk, right? We're moving the risk from when you buy insurance, we're moving the risk from you, the insured, to the insurance company. In surety, we're removing the risk from the owner of a job to a third party, which would be the surety company. We're going to talk about the parties to the surety bond now, so you kind of get a better idea of how that works. I also want to say, if you've got some burning questions that you have to ask while I'm talking about something, I am okay being interrupted. If you want to, and I'm probably breaking rules here, and Tiffany can scold me later. If you want to unmute and raise your hand or ask a question, I'm totally okay with that. So don't be afraid. I think we have a small enough group that it won't distract from what we're doing. So please feel free to interrupt as I go along. All right. If you've ever seen my presentations, you know no presentation is complete without a Venn diagram. These are our parties to the surety bond, and depending on how big your screen is, you can see that the bond here is in the middle. I don't know if you can see my little cursor is in the middle there, and then we have our three parties, and then between each party, there are agreements. We're going to go over the parties right now in more detail. Okay, so our first party to the bond, our three-party, our tripartite agreement, is the principal. So the principal is usually, again, because nothing's absolute, is usually a contractor. So when you're applying for a bond, you are the principal. You are the one ultimately responsible for completing whatever the obligation is that we're bonding. You're the first in line to complete that obligation. The next party to the agreement is our obligee. This is a word that you're probably not going to see in any other industry other than construction and surety. The obligee is whomever you, the principal, has a contract with. So if you have a contract with the port, the city, the county, or you have a contract with a general contractor, that is the obligee. That is the entity that you are obligated to, right? So the obligee is whomever you have a contract with. They're also going to be the ones that hold the bond. They're the beneficiary of the bond. So you, the contractor, are never the beneficiary of your bond. It's always a third party, and it's always going to be the obligee. They're also the entity requiring the bond. So they're going to be the ones that say, hey, you need to go out and get a bond. And the third is, or a third party to our bond is the corporate surety company. And the reason I put the word corporate in there is because I want you to know that there is such thing as an individual surety. Because surety's been around such a long time, there is a statute in the RCW that says that in the state, most contracts don't allow it, but in the state, there is a statute that says somebody could be an individual surety, which means that any one of us, if we wanted to, could be a surety. Not a surety company, we would be surety, right? One, I don't recommend anybody here be a surety. And number two, I don't recommend anyone here use an individual surety. Ultimately, the surety company is the money behind the guarantee, right? They're the ones guaranteeing that you, the principal, are going to perform the contract to the obligee. It's usually an insurance company. And I think of them kind of like a co-signer. So they're signing on this piece of paper, this bond, to say that you, the contractor, are going to complete the job and perform on time to specifications and so forth. Oh, go ahead, Emily.
Yeah, I've got a quick question. You mentioned you would recommend not going with an independent surety provider. I'm just curious about that. Can you talk a little bit?
Well, mostly because most owners aren't going to accept it. So if you're the port, you're going to want a surety company that you know has the funds behind them.
Gotcha.
So let's say the contract is $1 million. So you, as a port, probably don't want to say, oh, this Joe Schmo can be a surety company, and then you have to kind of underwrite, do they have $1 million
Mm-hmm.
to guarantee it? So you as an owner or obligee are probably not going to accept it. And then two, if you're a principal, you want more than Joe Schmo to be behind you and guarantee this, right? You're paying for it. It's going to cost more as an individual surety. So if you're paying for somebody to guarantee something and satisfy the contract, you want to make sure it's a strong surety company.
Right. So it might be tempting to go with somebody who's cheaper and more independent, but they won't satisfy the requirement probably, and they
Probably.
won't give you the assurance or like the value that you are paying.
Right. Right.
Gotcha. Thanks, Carol.
Awesome question. Thank you. Um, I took this picture before I did this class because I thought it was funny. This is my dog Sunny. Bail bonds are sort of like our civil surety bonds. So what we write are civil surety bonds, but bail bonds, and most of us have either seen it in a movie or a TV show or read about bail bonds in a book. But it's the same. They're the same surety companies. It's a very similar piece of paper. So if you can kind of get the idea of how a bail bond works, you sort of have an idea now of how civil or construction bonds work. So a bail bond guarantees that an alleged criminal will appear in court, right? That's the guarantee. And if they don't appear, then the surety or the bondsman, the bondsperson, has to go get that person and make them appear, or they have to pay whatever the bond amount is. So that's why you see things in like movies and books where the bondsman is, going and hunting for these people to make them appear so that they don't have to pay out on the bond. So I like these kinds of visuals because I'm a visual learner, and I like to see this. It just solidifies further that this is not insurance and this is a guarantee. This is going to help a little bit more too. The history of surety. I was terrible in school for history. Pretty sure I would have flunked if I didn't do extra credit. But the history of surety, because I'm a big surety dork, is very interesting to me. The history of surety been around, so there's a whole lot more between 2700 BC and 1894. But this is the earliest known reference to a surety contract. It wasn't until 1894 that the federal government in the United States enacted what was called the Hurd Act. And this was the guarantee or the requirement that the federal government wanted to protect our tax dollars and make sure that the contractors that they hire are going to perform the contracts. So the idea is to protect the federal government and our tax dollars and make sure that they're hiring pre-qualified contractors. So that's basically what we do as a surety and as a surety professional. We're pre-qualifying the contractors to make sure that they can perform. In 1935, the Hurd Act was replaced by the Miller Act. Miller Act is still in force today. So in 1935, the federal government said any contract over $100,000 has to have a performance bond, which was this HURD Act, right? And a payment bond, which this Miller Act added on that payment guarantee. So now the federal government is saying, hey, we want to make sure that the jobs that we're paying for, our tax dollars are paying for, that they are performed on time to specifications, and that the contractor is going to pay their sub-suppliers and material people. In 1935, the federal government went to the banks and said, you need to come up with this product and guarantee, because this is a credit relationship, right? They're going to put up a piece of paper that says this job at $100,000 is going to be guaranteed. In 1935, which I'm sure none of us were here for, the banks weren't doing so good. And the banks were like, we can't handle it. We're not going to do this. However, surprisingly, or not so much, that was sarcasm, the insurance companies had money. And they were like, we'll step up, we'll take care of this. And this is why in the United States, Canada, and Mexico, this particular bond, the performance and payment bond that was enacted in 1935, are issued by insurance companies. In Asia and in Europe, these bonds are issued by banks. They're letters of credit issued by banks, and the insurance companies were not getting involved. It isn't until the last several years that the surety companies or insurance companies started to get involved outside of the Americas. So that kind of just reinforces again that this is not an insurance product. It just happens to have fallen into it because in 1935, that's who had the money. This is a federal act, the Miller Act is. Every state in the union also has what's called a Little Miller Act. And this is really common. Most federal acts will have a smaller Little Act that basically mimics what the federal act is. So in the state of Washington, the Little Miller Act is, and actually the federal Miller Act is now too, any project over $150,000 must post contract bonds, the performance and payment bonds. All right, enough of our history lesson. Okay, let's talk about actual bonds. So we know the parties to the bonds, we know a little bit about what a bond does. These are our main categories. So we have contract, which is meaning construction contract bonds, and then we have commercial bonds. I'm not going to go over much on the commercial bonds. We'll touch on this a little bit, but we're going to concentrate on the contract bonds because this is probably what's going to touch your lives more than anything else. The commercial bonds include things like your contractor license bond. And what these bonds do, basically they strengthen the statutes that are associated with it. So these bonds are, they feel a little bit closer to an insurance product because when you purchase them, it's for a term, it's probably for 1 year. And it doesn't take as much work to qualify for them. But in the state of Washington, we have contractor license bonds, we have motor vehicle dealer bonds. So an auto dealer will also have to go through the same stuff that you guys do for getting licensed. And there are other industries that also have license bonds to basically strengthen those statutes. The court and probate, this is where our bail bonds will fall, but also there are civil court and probate bonds. So if you've ever had to administer a probate and there wasn't a will, sometimes the judge will require a bond to guarantee that you, if you're an executor, are going to administer the funds for that estate properly. Another one that kind of falls into the court one that might touch your life eventually, hopefully not, are release a lien bonds. So there is such thing as if there's a lien on a private job, because you can't lien public works jobs, that can be released or suspended or replaced by a bond. Very difficult to get, almost as hard as getting a bail bond. Financial guarantee bonds are let's see, what would touch your lives? Maybe a lease bond. So if you've ever leased something or rented something and you didn't have any credit or weak credit, or you were brand new to the owner obligee, they might ask for a deposit, right? If you're renting, if you rent something, you're required to post a deposit. Sometimes utilities will require that you post a deposit. Sometimes that deposit can be replaced with a bond. And basically, it's a financial guarantee. So again, the surety company is setting the money aside for you for that financial guarantee. Okay, enough of commercial stuff. Let's talk about contract bonds. These are going to be public works contract bonds because this is where we're going to see most of the bonds. Most private works aren't going to require bonds. We're going to start with bid bonds. Then we're going to talk about performance and payment bonds. The bid bond, so this is going to be the one that you're going to run into first after you have your contractor license bond, right? Because you're going to bid the job before you actually get the contract. This bond guarantees that if you are the low successful bidder, you will enter into a contract and you will post the required performance and payment bonds if there are any. This bond is usually a small percentage, 5% usually in Washington. Other states sometimes will require as much as 10%. The federal government requires a 20% bid bond. So this is similar to what I was saying before. It's a deposit, right? You're putting up through your surety company, you're putting up a deposit of 5% of your bid to say, hey, I am pre-qualified, and if I'm the low successful bidder, I'll enter into a contract and provide the required bonds. The idea of the small percentage is this is what the owner could lose. So let's say the port puts out a bid and let's say they didn't ask for bid bonds, and you're the low bidder and you can't for some reason, or you've changed your mind, you don't want to enter into a contract. Whatever the cost is for them to either re-tender or re-put out the bid or go to the next bidder, hopefully it's in the 5 or 10% range, hopefully this bond covers that cost for the owner, for the port. The surety company, when they underwrite the bid bonds, even though the risk is only the 5 or 10%, the surety company is underwriting based on 100%. So let's say we're talking about $1 million bond, or $1 million contract. Your bid is $1 million. Your bid bond is only 5% of that. So it feels like we should only be underwriting on 5%, right? That's our risk. That's your risk. However, the guarantee is if you are the low successful bidder, we're going to issue the next bonds, which are the performance and payment bonds, and those are 100%. So when we underwrite these bid bonds, we're underwriting you as a contractor for the $1 million, not for the 5%. This is a little bit easier to understand because it basically says what it is in the name, performance bond. The performance bond and the payment bond, which is the next one, they are going to go together. We issue them usually together. The performance and payment bond are attached to the contract. So our bond form is usually, if you've ever seen one, it's like 1 or 2 pages. The performance and payment bond are attached to the contract, and we guarantee everything in those contract documents. So we're going to ask for a copy of the contract, and we're going to look through the contract for anything onerous, anything you should know about that you might have missed. So we need a copy of the contract as well as the bid results. We want to know that you are in line with the other bidders. And if you're not, we just hope that we can work around that. And I can go into that a little bit more maybe in our advanced class. So we're guaranteeing everything in that contract, even if the contract changes, which happens a lot. If there are any change orders to that contract, the bond is still attached to that contract and is guaranteeing those changes. The payment bond, as it says, is guaranteeing payment to subcontractor suppliers and material people associated with that. And this is the Miller Act bond, or Little Miller Act bond, if it's in the state of Washington, and guarantees payment to sub-suppliers and material people. Okay, so now we know what the three kinds of bonds are that are available and required. This is another visual that I like because it helps me see who's who. Uh, in this project hierarchy, we have the owner, which is our obligee, right? And in this case, let's say it's the port. So the port hires a contractor, general contractor, right? In this case, the port is our obligee, right? If we have a bond here between these two parties, the port is our obligee, and the general contractor is the principal, right? However, if, or in addition, if the general contractor hires subcontractors, that let's say it's a very large contract. Let's say it's a $50 million contract. The suppliers or the subcontractors to our general could be quite large, right? So the general contractor might ask for bonds from these subcontractors down here, right? And now the general is the obligee on this bond and this bond and this bond. And the subcontractor is the principal. Make sense? It's easier, I think, for me to see in a visual there. All right, the life of a bond. So oh, go ahead, Emily. Thank you.
Hey, Cara. Question, where does retainage fit into the
That's a really good
previous
question. I'm going to
slide?
go into retainage. I was going to save that for
Okay.
the advanced class.
Okay,
Um,
great.
oh, partially because, so here's what I will say. It can get quite complicated. It's very unique to the state of Washington, and now Oregon. Other states are coming up with their own statutes. It is not required. The performance and payment bond are required by statute by our Little Miller Act. The retainage bond is an option. So that's why I thought I would save that for, and it's kind of, it gets even more complicated in here when we have retainage bonds. So I was going to save that for the more advanced class.
Gotcha. I'll be
So,
on the edge of my seat for a
okay, good.
week until next week. Thanks, Cara.
Okay. Okay, the life of a bond. So first it comes from the obligee, right? So let's say the port says in their specifications, you have to have a bond on this particular project. So the obligee then goes to the principal, says, hey, you contractor, you need to provide a bond. And then you, the principal, you'll go to your insurance agent, right? Or a surety professional. Sometimes the insurance agent will come to us. So sometimes we're like a subcontractor to the insurance agent. So the insurance agent might come to us, and then we might issue the bond through that insurance agent. And then we, or the insurance agent, goes to the surety company, right? Then we issue the bond, right? Either contract or commercial. And then where does it go? This could be rhetorical unless somebody really wants to answer. It goes right back to the obligee. So this is the circle of life for a bond. The reason that I did this is because I have found that a couple of times it's gotten to the point where we've issued the bond, we've given it to the contractor because the contractor is a party to it. The contractor has to sign it. Our principal has to sign the bond because they're a party to it. And then they hang on to it because that's what you would do with an insurance policy. You get your insurance policy and you file it in a drawer, or, I'll just leave it at that. For a bond, the bond is not being held by you, the principal. The bond needs to go back to the bond holder, our obligee here, right? Thoughts or questions? All right, this is allegedly the number one question on the internet for bonds. How much does it cost? Usually bid bonds are free. It costs, you're not making anything, right? So we're not making anything. There are a handful of surety companies that have charged a nominal, like an annual fee of $500. Every once in a while, we'll see that. I haven't seen that in a long time. So typically bid bonds are free. Performance and payment bonds, on the other hand, can be as much as 3%. And when I say 3%, I'm saying 3% of the contract price. So let's go back to when you're bidding the job, right? When you bid a job and you're looking at the specifications, so whether you need a bid bond or not, if a performance and payment bond are required, you need to add your premium, if it's 3% or whatever it happens to be, you need to add that to your bid. This premium, remember, you're not the beneficiary, right? You don't benefit except for being able to enter into a contract. You don't benefit from this bond. It is the obligee. I'm going to pick on the port today. The port is the one requiring that you post this bond. So they're the beneficiary, so they need to pay for it. So if there isn't a line item, you need to get that bond premium in there because the obligee is expecting to pay for this. And maybe Emily knows more about that. But they're the ones being protected, so they're the ones that need to pay for it. 3% is the average for a new contractor coming in, a contractor that is doesn't have as much experience maybe, or their financial statements aren't as strong. Once you have been in business for a length of time, you have grown your business, this premium will go down. There are a handful of things that can do that, including stronger financial statements prepared by an outside CPA, experience, the ratios in your financial statements. And this is something else that I'm going to talk about a lot more in our next class. We're going to talk about how to lower the cost of your bonds and how to increase your bond limits. But this is a good place if you're just starting out and you're not sure, I would estimate in your head about 3% of the contract price. So if for some reason you're required to post a bond that is not 100% of the contract, because I have seen sometimes it's a 50% performance bond, 50% payment bond of the contract price, your premium is still based on the contract price. So keep that in mind when you do change orders, because the surety company is going to audit this at the end of the job. And if the contract price increases, you're going to get an invoice for that increase. And again, remember from the beginning, this premium should not be coming out of your profit and overhead. This premium should be paid by the owner. So you need to get that additional premium into your change order if it is increasing. Some of the other bonds, most people here probably already have their contractor license bond. I've seen them as low as a few $100s to a few $1,000s, depending on credit. Most of your contractor license bonds are underwritten just on your credit and nothing else. All right, we're going to talk briefly about the different types of contracts. The contracts that we're going to bond are the lump sum fixed firm price contracts. We're rarely going to see the T&M contracts get bonded. And for contracts, if it's not in writing, it didn't happen. Please, please live by this. Change orders, if you do not have a process or a procedure already in hand, do some research and make a really strict policy on change orders and everything else for your business. But the change orders could really hurt you if you're not paying really close attention, and if you've got people in the field that aren't really paying attention. If it's not in writing, it didn't happen. So every contract needs to be in writing. Every contract, even the nice handshake ones that you're doing for friends, please, please, please put it in writing. Some of the key elements of a contract, I've listed them here, but I highlighted the two that I noticed that don't always get the most attention. Everyone's paying attention to the scope and the payment and the schedule because that's what you're working with on a day-to-day basis. But two things that we're going to ask about are the workmanship warranty, which is sometimes called the maintenance period, and liquidated damages. So for most public works contracts, you're going to see probably a 1 year workmanship warranty. This is not warranty for the product. If you're supplying anything, like if you're an HVAC, the HVAC that you're bringing in, it's not the warranty on that. This is your workmanship warranty. And you as a contractor, you really don't want a very long-term workmanship warranty. You don't want to have to come back 5-10 years later to a job that you thought was done. So we're going to look for that. We're going to ask some questions if it's more than 1 year. 2 years, probably okay. But we're going to have some questions if it's any more than that. The liquidated damages, sometimes we call them LDs, are basically penalties for late completion. And this is something else that I've seen some really wacky clauses. Most of the time, it is a dollar amount per day that you are penalized if you don't complete on time. So something in the, a few $100s a day to maybe even $1,000 a day. Not great, but it's doable if you have it to lose, and hopefully you never run into penalties for late completion. But I've seen some 10,000 a day. I saw somebody working on I-5 and it was by the 15 minutes. There were penalties for late completion that were assessed every 15 minutes. So we're going to help pay really close attention to that and ask you about it. Sometimes if you're a subcontractor, you might not see these. So in a subcontract, a lot of times the general contractor will give you a contract that says anything in the main contract is now part of your contract. You as a subcontractor have every right to get a copy of that main contract so that you know what you have to do, because you have to do everything in that main contract. So you have every right to get a copy of that. So don't let anybody sway you from getting a copy of that contract. And so if the main contract has wacky LDs and warranty, that's going to flow down to you. And you have every right to try to negotiate that. Please don't be afraid to try to negotiate, especially if they're really wacky. And the general contractor is probably much larger, deeper pockets, so they can handle that kind of thing. But if you have a smaller subcontract, there's no reason for you to have to put up with anything too wacky. Indemnity, this is a word that is, again, opposite in surety than it is in insurance. So in insurance, the word indemnity means in general, means to make whole, right? So when you have a claim for your auto or your home, the idea is that the insurance company makes you whole, no more, no less, right? So you have a loss on your home, a fire, the insurance company will come in and make you whole. In surety, it is the opposite. The indemnity agreement that you sign as a contractor with the surety company says that you are going to make the surety whole if there is a default or a loss for the surety company that you potentially caused. So if the surety company has to step in and complete a job or pay sub-suppliers or material people on your behalf, the surety company will take care of it and make the general contractor or the port or our obligee whole. But then they're going to come back to you, because this is a credit relationship, right? This is not insurance. They're going to come back to you. So we only want to issue bonds for you if you absolutely have to. We're going to talk a little bit about underwriting. I'm going to go a little bit fast. Underwriting basically just means we're going to verify information to try and get an approval. We go to underwriters at surety companies. So I represent the top 50 surety companies in the nation. So I'm going to go to an underwriter to get that approved. And we were joking earlier about the 3 C's. I think, does every industry have like 3 C's, 4 C's, 5 C's? Here are the 3 C's for surety: character, capacity, and capital. Character is basically honesty, openness. If you've been in this business for any length of time, you know how to judge character, because you're working with owners and you're judging their character. You're working with suppliers and subcontractors and you're judging their character. Capacity is, do you have the ability? Have you ever done a job like this before? Have you done a job this size before? Do you have the manpower, people power? Do you have the equipment to do the job? That's what capacity is. And then capital is our final. And I put this in this order on purpose. I think character is most important, and capital is important, but it is not the most important. However, it is going to feel like it's the most important because this is the thing that we can take, we can see and we can ask about, and we can judge. So we're judging your character a lot on capital and capacity. If you pay your bills on time, um, if you are managing your financials well, that is a character issue because it's a lot of what we have to go on. These are some of the things that are important when we're looking at larger jobs. We're going to need an application or a questionnaire, financial statements. I'm going to say, if you haven't already, look for an experienced construction CPA. They don't have to be doing your day-to-day books. They don't even have to be preparing financial statements for you if you're just starting out. However, doing construction accounting is very different from any other industry. And we're going to go into a whole lot of that in the advanced class. But look for somebody who understands construction. And even if you can, find someone that specifically understands your construction and your business. Not super easy. We have some references if you need that. Personal financial statements, bond request, resumes, and then I'm going to say the same thing on the bank line and bank statements. If you don't have a bank relationship, think about developing a bank relationship. Find out if they understand your business. There are a lot of banks and bankers. It's probably more bankers, the people. Either they understand construction and they understand your business, or they don't. So interview your bankers and try and find somebody who is experienced and really understands your business. If you've been in my class before, you've seen this. This is my job. I am making a presentation on your behalf to what looks like Shark Tank people. These are my surety companies here, right? So I'm making this presentation to them. So I'm going to try and get and make the presentation look as beautiful as possible. I'm going to be asking a whole lot of questions because if we're weak on the capital C, I'm going to ask a whole lot more on some of the other C's to kind of supplement that. So what we're looking for is this, right? And not this. And how do we do that? I need a complete submission. I need some time. So please go to your surety professional at least a couple of weeks. As soon as you know you're going to need a bond, or you might need a bond, even if you don't know if you're going to bid the job or not, but there's an opportunity and a possibility, go to your surety professional right away. I would rather underwrite and take a look at something that you're not going to bid than look at it at the last minute and not be able to get it for you. Communicate and relationship are so important, and it's not just in surety, it's not just in construction. This is your life in every aspect of your life. Strong communication skills will build strong relationships and will go a long way. So where do you get bonds? Your insurance producer, they'll sell you, most of them will have some access to some surety. You're going to be better off going to a surety bond producer, somebody who knows a little bit more about surety, but a lot of insurance professionals either know about it or at least know someone like me that they can work with to help get your bonds. We're getting really close to the end. These are some red flags, and these are some red flags for us, the surety, but when it's a red flag for us, it's also a red flag for you. We're a team, right? So an increase in job size, if your largest completed job's 100,000 and you come to me for 10 million, I'm going to have some questions. If you normally work in Washington and you find a job that looks awesome in Alaska, it's not the same. We all know that. So we're going to have some questions. And then if you decide to go into a new scope of work, you've been making money at one thing and you're like, oh, now I think I want to do this other thing. We're going to have some questions. So I'm not saying that these red flags mean that you're going to be declined. What I'm saying is if you have all three, you will probably be declined. If you have just one of them, just an increase in job size, but it's in your territory, it's with an owner you know, it's a scope that's really easy for you, we might be able to do it. So we're just going to ask a whole lot more questions if we have any of these things. Uh, why are we doing this? Competitive advantage. You have a partner with your surety. So the surety company and your broker have resources. I think I was saying this early on to somebody. The insurance company has money. They do. They're insurance companies. They have engineers on staff. They have attorneys on staff. They have a lot of experience. Use them as a partner. And that, look at that. I think I'm like right on time. Here's some more information. If you go to integritysurety.com, I've got a bunch of videos on there. Littleblackbondbook.com. If you go to thebonder.com, that tells you a little bit about how I got in the business, how my father got in the business, and how his father got in the business. And they're actually cute little stories. It's like a little paragraph and tells you where the term the bonder came from. So the bonder is not an industry term. This is something that my father and I kind of made up, and you can read about it there. And questions.
Yeah, thank
Did I
you,
talk too fast?
Cara. That super helpful overview. I think it's helpful to know the history and really what is a bond and what goes into it, so that firms can develop better partnerships with you,
Yes.
um, or their own bonding agent.
Mhm.
Okay, I'd like to open it up for questions. You're welcome to unmute. You can raise your virtual hand or you can type it in the chat. My first question while we're waiting for other people to come in is related to developing that relationship with you. So you said we're a team, we're a partnership,
Mhm.
we're in this together, I'm on your side.
Yes.
But how do you do that? So
That's
if I'm
good.
a super busy construction company owner, um, and I don't really fully, you know, like I don't really, I just want the bond, I just want to move on. What is the minimum? Like, what do you want from me
Okay.
at a minimum to develop that partnership?
That's an awesome question because actually, I think you have probably just described a whole lot of people out there. They just want the bond. They don't care about, that it's not like insurance. They want the bond. They want it fast. They want it the least expensive,
Mhm.
and they want as much as they can get. Right now, most of the surety companies will allow about $1 million, somewhere between 750 and 1 million, based on, I'm going to say, just credit. But it isn't really just credit. So the surety companies are going to want to see that you've been in business for at least 3 years, that your credit has to be pretty strong, and you have to have completed jobs in the size that you're looking for. So if that's all you want and you're okay with 750 to 1 million, it is a foot in the door. And it's probably just a little bit more complicated than applying for a credit card, right? You're going to fill out an application. It's going to be a little bit more information, but we're going to run credit and then we'll be able to offer you. It's not going to be the cheapest, but it'll be fast and it probably won't be more than 3%, or it won't be much more than 3%. We're regulated by the insurance commissioners of each state, so we can't play with premium the way, and I don't know why insurance companies can, but on the insurance side, somehow they can. Um, it's a foot in the door. So here's what I would say. If you want something fast, that would be a step, and that would be your first step. And then once you have kind of gotten used to it and you've done a couple of jobs like that, we can set up a phone call. And we can do it like this on Teams or Zoom. Um, as you grow and become larger, more sophisticated, you want larger, long-term jobs, you're going to have to invest a little bit of time, and meet with me a little bit. At least talk to me on the phone a little bit. So you remember when I showed you the visual of the Shark Tank? It makes my job so much easier if I can say, "Hey, I talked to Tiffany. She's awesome. She's done this. You've told me your origin story, so I can kind of go into that when I'm making my presentation. The more information I have, the better presentation I can make on your behalf." Once you're a little bit larger and you want some larger jobs, the next step is to introduce you. So Tiffany, you're my contractor. I'm going to introduce you to the actual surety company, the underwriters at the surety company. And I think this is pretty unique. I don't think the insurance side, and maybe somebody can tell me, I don't think insurance underwriters will come meet with you regularly, but I meet with my larger contractors regularly, and I will fly my underwriters. So I've got contractors all over the state or all over the United States. We'll fly them out at least every 2 years, sometimes once a year, to meet with them, because remember, character is number one. And how do you judge character? I don't want it to all be on financial statements, right? I want it to be on, meeting somebody and hearing their story, and hearing the every contractor here has had a problem on a job. And I want to hear how you handled the problem on the job, because that is character.
That's super helpful. Thank you, Cara. Couple more questions in the chat
Yeah.
here. Based on your experience, do public agencies ask for bonds for sub-consultants who provide engineering services like consultants?
Not usually. And in fact, there's a new or updated statute that says, so there are construction contracts out there called design build, and I don't know if it's ever touched your lives yet, but the design portion of that contract does not need to be bonded.
Great.
So first of all, surety companies don't want to do it, and it's kind of hard to guarantee. We can guarantee that it's done, but really the guarantee that you want as an owner is probably a little bit deeper than that, and the surety company doesn't want to guarantee that the building's not going to fall down.
Okay. Aaron asked, what is a bond rate? I have a
Oh,
GC that will bond the small and new subs, but needs to understand bond rate.
so here's what I'm assuming. So bond rate, so your bond rate, so if you Tiffany or Aaron, you're the contractor, and a GC comes to you and says, "What's your bond rate?" If you need to talk to your surety producer professional, but it should be that 3% or whatever it costs for the bond. That's what it sounds like when in our industry, that's what rate means. However, there is a rating which is different for the surety company. So the surety companies, all the surety companies I work for are rated similarly to insurance company under the AM Best. So AM Best is a third party that rates insurance companies based on their financials. So if they're using the word rating, which is a little bit different, they might be looking for your insurance or your surety company, pardon me, your surety company's rating. I would suggest, and I can show you how to get to the AM Best and find out what your surety company rating is. But you probably want an A minus or better in the rating, if that's what you're looking for. Let me know, Aaron, if that was not what your question was.
It
No,
kind of, oh,
Go
thank
ahead.
you. I appreciate it. And I'm pretty sure that it's that 3% number
Okay.
because they're asking about my bond rate so that they
Yeah.
would cover the bond for me as their sub.
Perfect.
Yep.
Perfect. And
Thank you.
hey, Aaron, if you're looking they shouldn't be judging you by that. They should just be paying it. But if it feels like they're like, oh, well, that's really expensive, talk to your surety professional. And we might be able to get it down to like 2.5 easily. Getting it much lower than that's going to mean a whole lot more work for you as a contractor and cost you more. And the return on investment might not be there.
Okay. Appreciate it. Thank you.
Yes, of course.
we have a question about discrimination in the bonding space. Have you seen this and how do you help firms navigate bias?
That's a really hard question. I'm sorry if it's out there. I'm sorry if you felt it, and I'm sorry if you've seen it. I hope it's not. What we should be looking at is how long you've been in business, your experience, and we shouldn't be looking. We have no reason to look at anything else. I haven't seen a whole lot of it. We want to write bonds. Um, I think it might be seen more on the construction side and the contractors that are chosen. I want to see somebody that has strong character and that has experience and really wants to work hard. And it doesn't matter who it is. It doesn't matter who you are. I can see that the small emerging contractor might not have the experience. And that might feel like there's some bias there. There are some tools that we can use. It only helps a little bit, but I think it's worth mentioning, and that is you are new. Let's say you are new in business. I'm gonna pick on you, Tiffany. You're brand new in business. You're 1 year in business, so it's gonna be a little bit hard to get the larger surety bonds for you. But here's what I'm gonna say, Tiffany, get me a resume and show me all the other construction companies you worked for, and not just a regular resume. I want to see like the projects that you did and what you did on those projects. Were you estimating? Were you project managing? That kind of thing. So again, keep in mind, I'm going to be presenting you to that Shark Tank, right? So the more information I have to help bolster that and make it look great, and I really don't care about anything else. And I hope that other people don't as well. I know that's not a great answer. I hope that's helpful though.
No, that is helpful. Do you provide services in other states
Yes,
or
we're licensed nationwide.
nationwide? Okay, wonderful. Thank you. I don't think I see any other questions in the chat. Those were excellent questions that came through.
Thank you.
In the chat, if you haven't perused, Leslie has been posting super helpful links as well as Kara's full contact information. Kara is so generous with her time and expertise. And like I said, I'm pretty sure her dinner table is all about bonding. And so she just would be happy to help you be successful in this space. The Apex Accelerator exists to help you be successful in winning the contract, and we can help you comply with things on the back end. But when it comes to negotiating with your bond agent, we're grateful for people like Kara that are out there helping firms navigate it with an expertise that is unmatched. So, Kara, thank you for your time today. Thank you to the Port of Seattle for allowing us to do this training today, and we are signing off. Thank you.
Thank you, everyone. Really appreciate it. Have a great day.